Hi all, welcome to this tutorial. So in this tutorial, we are going to cover some concepts related to some concepts or some terminologies which is related to financial statement analysis. So the first thing is economic versus accounting profit. So what is economic profit and what is accounting profit? So these are two concepts actually. The accounting profit is straightforward. This is the profit or loss from the profit and loss account. Or it is the accounting profit is the bottom line reported on the income statement. It follows the actual accounting and GAAP or IFRS standard. So the formula for accounting profit is total revenue minus total explicit cost. That means total cost, explicit cost like wage, rent, raw material, depreciation and tax. All these are explicit cost. So the accounting profit is used especially for financial reporting, tax purpose and historical performance review. This is about accounting profit. But the economic profit, in the economic profit, it is always similar to accounting profit, but it is considering one more element, that is the opportunity cost of resources used. Suppose if a company is running, it has its own accounting profit from the profit and loss account, but there are some explicit or some opportunity cost can be related to this company. So suppose the opportunity cost of the invested capital or opportunity cost of the owner's time or owner investment, time investment, effort investment, all these can consider as a opportunity cost in the business. Suppose a company, an investor invested 100,000 rupees in a business and he made some profit. In the same case, if he has an opportunity to invest is in the very low risk investment opportunity, that is a fixed investment. Suppose with this investment, if he invested in the other investment, suppose he can get a 10,000. So this is an opportunity cost for this money. Opportunity cost means the cost, the benefit for forgotten benefit of next best alternative. Suppose the interest foregone on invested capital or on owner's potential salary elsewhere. Suppose the owner working for the company, owner working in the same business. So there might be an opportunity cost like owner's potential salary if we work somewhere else. All these are the for opportunity cost for the business. So in the economic profit, we are considering this opportunity cost as well. The formula for opportunity economic profit is accounting profit minus all implicit cost. These are implicit cost. The other cost like we are reporting in the income statement, that is explicit cost, and these are implicit costs are the all opportunity costs related to that investment. It can be the investment of a capital or investment of time of owner or the investment of owner effort, everything can be considered in the economic profit. Suppose, so these are the some key concept and key difference in the with the operating profit and economic profit. So in the accounting profit, we are considering only the explicit cost only, but in the economic profit, it is explicit and implicit cost. Both costs we are considering, explicit and implicit. Again, the prospective, if you are looking into prospective, accounting profit normally is backward looking. It is looking into historical performance. But when it comes to economic profit, it is a forward looking and it will help the owners or the management to make various decisions or supporting decision making. And the visibility recorded on the financial accounting profit is recorded or reported in the financial statement. But normally the economic profit will not record on the books, company's books of account like income statement and balance sheet. The economic profit will not report in these reports. The goal of accounting profit is to ensure the financial transparency, but the economic profit is to ensure the resource allocation efficiency. So these are the two concepts, the accounting profit and economic profit. These are the accounting profit mainly for the accounting recording purpose and historical, it is keeping as a historical record. But when it comes to economic profit, it is considering the implicit cost as well compared to accounting profit, and which is helping the companies to make various decisions whether this investment is feasible, what is the real value addition an owner or an investor can expect from the investment. So this is economic profit and accounting profit. So let's move into next concept, that is earnings quality. Earnings quality mean it is a name itself. It is mentioning the quality of the earnings. Earnings mean the revenue. There are some metrics or some methodologies that can use to evaluate the earnings quality or the quality of the revenue of a company. Again, the earning quality refers the ability of reported earnings to predict a company's future performance. It measures how real sustainable profit is. If a company have high quality earnings, that mean in that case the characteristics of high quality earnings. The first one is cash flow correlation. Again, earnings are backed by cash flow inflow. If net income high but operating cash flow is low, then the quality is poor. Suppose if a company have earned a good profit or big revenue, but when it's looking into its cash flow or its operating cash flow or its collection, it is less than the expected or less than the actual earnings or actual profit. It can be a sign of it can be a red warning to the company because there are some issues with that earning quality. Then the conservative estimate. A company uses realistic accounting estimate. Example, reasonable bad debt provision and depreciation. A company can take two approaches like conservative approach or other approach to estimate for the estimate like the bad debt provisions, depreciation. All these are the estimation decided by the company's management. If the companies are estimating on a conservative basis or conservative approach, that can be a characteristics of high earning quality. Again, if this company is making earning or the net profit, that is the code, that is the symbol or a characteristics of high quality earning. Then the repeatability. If a company's profit come from a core business operation rather than one time gain. Suppose if a company's profit is mainly coming from its core business operation, core business activity, not from a one time gain, so that can be a characteristics of high quality earning. So if you are analyzing a company's performance, you can see if we can correlate cash flow with its earning or its income, or the conservative estimate. If the company is used to conservative estimates and the profit come from the core business operation, and there will be a good chance to repeat that profit. So if these characteristics are there, we can consider that there is that company have high quality earnings. Again, the red flag, that is a low quality earnings red flags are then the aggressive revenue recognition. Maybe if companies recognize revenue before it's actually earned, so this can be a red sign for the low earning quality. Then the frequent one-time charges, constant restructuring costs appear every year. Again, restructuring cost appearing every year or frequent one-time charges is showing in the income statement, or in that can be a red flag for the earning quality. Then the changes in the accounting policies. If company is changing frequently from one accounting policy to another accounting policies like depreciation method or inventory valuation method, this can be a red flag for the earning quality. Because if you are changing this method or this accounting estimate, the profit can be changed than, or it can inflate profit than actual, or sometimes it can deflate also. So if a company changing accounting policies is frequently, that can be a red flag for the inequality. Then the management bias. Then over-optic assumption regarding pension liability or asset impairment. Again, the management bias on the pension liability or asset impairment. If there is a over-optimistic assumption on these pension liabilities or asset impairment, so that can be a red flag for the inequality. So normally, high quality earnings are unbiased and sustainable. They reflect the underlying economic reality of the company rather than the clever use of accounting rules. So if a smart accountant or if a smart accountant can use some clever use of accounting rules to evaluate or to show a good profit in the income statement, but that cannot be the actual profit of the company. But here what we are measuring, the quality of the earning that reported in the income statement. Suppose if an income statement showing a profit of $100,000, suppose, and we have, as a financial analyst or as a financial statement analyst, you have to analyze the actual earning quality of that 100,000. Is it is from the real earnings, or is there any inflation or any inflated earning affected here, or this is only the this is this is actual company performance or not. So that you have to analyze. After analyzing the earning quality, you can analyze this, if this is the real earnings or not. Then we'll move to next concept, that is earning persistence. Earning persistence means that the chance how long the current level of earning is expected to continue in the future. Again, if there is, suppose, 1 year, this year company have a good earning, so we are assessing, or we are seeing that how long this company can sustain this earning, or this is a temporary earning, or this is a persistent earning. Persistent earning means it can sustain in the business for a long time, maybe for the next periods as well. So the earning persistence is measuring whether this earning can persist in the business for the coming periods as well. So that to analyze the persistence, we categorize earning into two types. Then the permanent earning. Permanent earning means this can expected to recur period to period. Period to period. But maybe if this is happened this period, we can expect to have that sales in the next period as well. Suppose a sale is from a core product line or core business activity, that can be a permanent earning. But a temporary earning, there are, suppose if the companies gain something from a legal settlement, or something for a temporary basic, or some gain from the sale of an asset. So this will not going to happen in the coming period. So this is a transitionary earning, this is or temporary earning. So this is about this today discussion. So what we discussed today is the economic profit. What is economic profit and what is accounting profit, and the key difference between economic profit and accounting profit, and the earning quality plus earning persistence. Earning quality mean what is the actual quality of our earning for this year, and earning persistence mean how long this earning can sustain, or this earning can continue in the coming period. What is the chance to repeat this earning or persist this earning for the coming period. So this is about today's discussion. If you have any doubt or you need any clarification on any of this topic, please ask me on the comment section. Thank you for watching this video.